Dr. Lacy Hunt, award-winning economist, chief economist at Hoisington Investment Management, an absolute legend and a friend of this show and someone we always look forward to talking to. It is so wonderful to welcome you back to the show and great to see you, Dr. Hunt. Really appreciate you taking the time to join us today.
My pleasure, Julia. Nice to see you as well.
Always nice to see you. And Dr. Hunt, we are recording on Friday, May 2nd, Jobs Day. We had quite a bit of economic data come out this week. I know your Q1 letter came out recently. A lot of folks have been talking about it on social media. And gosh, the last time we had you, Dr. Hunt, would have been in August, right after we got the huge downward revision for the jobs number. So it's been a while. A lot has happened. And a lot, again, I mentioned a lot of folks are talking about your letter and these kind of five forces at play in the economy. And I would love to talk about that, but let's just start where we always start with you. And since you are a macroeconomist, let's start with that big picture, that macro view, where we are today, your outlook. And as you know, Dr. Hunt, you can take all the time you need to set the table.
Okay. Well, right now we're in something of an interregnum in a variety of different respects. First of all, tariffs have been imposed by the United States unilaterally on others, and there's been a round of retaliations, which is to be expected in such situations, especially when global economic activity is as poor as it currently is. This was the pattern in the 1920s and 1930s. Ironically, the announcement of the tariffs has given the economy a boost in important ways. A lot of firms went out and ordered a lot of product from the rest of the world. Our imports had an unprecedented surge in the first quarter. And that means that things like GDP and employment around the world were actually helped initially by the tariffs. And the announcement of tariffs caused consumers who are really in very poor financial shape, I would say wretched financial shape, actually. They went out and they did a lot of buying in advance to protect themselves against the potential future price increases. We saw this in automobiles quite significantly. Huge surge in automobile spending started in the second half of April, carried over into the first half of, it started in the second half of March, carried over into the first half of April. We have anecdotal reports of it occurring in other areas, including iPhones. And there may have been other items that were less widely followed that also benefited from this. And so when firms see a surge in the demand, they're going to have more folks on hand in terms of employment to handle it. But that surge in demand that benefited the world and also components of the U.S. economy, that's going to go away. And so we're not going to have any data on that for a while. And so that leaves economists sort of in limbo. We've had an event. We've seen certain repercussions. One of the things that I think may have been overlooked is that while imports were surging and this benefit flowing to the rest of the world, the U.S. economy did accumulate a very substantial amount of inventory in the first quarter. And now firms have to move that inventory. And we'll see whether the consumer in a very emaciated state is in a position to do that. Another way in which we're in an interregnum is that we're experiencing a very significant drop in currently, and for this current fiscal year 2025, in federal spending. Now, part of the reason for the drop is that there was spending had a wild increase from October through January. And naturally, that kind of increase isn't going to be sustained. But more importantly, um, the budget that was enacted for 2025 um, is indicating that the increase in federal spending for the final 6 months of the current fiscal year, which started on the first of this month, the first of last month, 1st of April, is going to be basically flat. So we're going from a massive federal stimulus to a zero federal stimulus on the spending side, a decline in real terms. And we don't have an offset in terms of where we're going with regard to federal taxes. And so we have to sort of deal with two interregnums, one related to the tariff, another related to fiscal policy. And so it's very difficult to look through all of this noise. But I think when one does, we find that the economy is um, in a much more frail condition than is generally understood. And I would cite two uh, hard indicators of that. Number one is the ratio of job openings to unemployed, known as the Beverage ratio, and it is dropped very precipitously from the peak levels. But more importantly, it's below where we were prior to the pandemic, and this is an indication that the labor markets are tightening more significantly than is generally understood. Another hard indicator is what's happening to the rate of increase in average hourly earnings. You can measure economic activity or the strength of economic demand by quantity measures, or you can measure them by price measures. Well, wages is a price measure. And here, the evidence is entirely unequivocally weak. And we saw this weakness in April. We had only a 0.2 rise in average hourly earnings. Now, 1 month doesn't is never to be overestimated, but we have to remember at the peak, the year-over-year increase in early 2022 in average hourly earnings was 6%. And now in the latest 12 months, we're down to 3.75%. And that to me is an interesting and a significant development and indicative of the fact that the labor markets are much weaker than people generally believe. And so I would add one other minor little problem, and I don't like to get down in the weeds, but the economic statisticians have a great deal of problem always, in the best of circumstances, seasonally adjusting economic data. And one of the things that they never do a good job of is when Easter, which is a floating holiday, comes really early or really late. And this year we had an extremely late Easter. And that comes here at a time where we're trying to sort through the impact of the cutback in federal spending, which occurs with a lag, especially with regard to employment. It looks like that the Doge efforts have cut federal spending federal employment by about 200,000, but that doesn't mean they go off the payrolls immediately.
Mm-hmm.
They go off the payrolls rather gradually. And so we have to sort through all of this noise, and at the same time, um, there are the problems of trying to properly seasonally adjust when Easter occurs quite late. But I think once we get past this noise, the economy is going to show much weaker than people generally believe, and that we will have a recession.
So in your Q1 letter, and great frame up, Dr. Hunt, to the conversation. In your Q1 letter, you point out these five convergent economic considerations. And as you were just referencing, tariffs, monetary policy, fiscal policy, the debt overhang, and the demographics. And that all of these are kind of aligning to depress economic growth. Can we go through these forces and how you are seeing them converge?
Well, first of all, with regard to tariffs, I want to take you back to your course in microeconomics. I hope you had one.
Mine was a blend at Carolina. They did macro and micro together, but
Okay. And if you talk about the micro demand curve, you have to remember that the law of supply, the law of demand means that as prices go higher, demand goes down, so you have a downward sloping demand curve. As prices go up, if you're a producer, you will offer more. So when you have an increase in tariffs, the supply curve shifts. The supply curve shifts inward toward the origin and toward the left axis, the price axis. And so when that happens, the price level rises, but the quantity demanded and supply goes down. But the supply curve shifts up, it lifts up and shifts inward. So what happens as a consequence of this? Well, to answer that question, you have to understand how sensitive internationally traded goods are to price changes. And most goods in international trade are what economists call price elastic. In other words, if the price goes up, there will be a greater than proportional decline in quantity demanded. So price goes up, quantity demanded comes down, but quantity demanded falls faster than the price increase, and price times quantity is total revenues. So that happens to the country that is raising the tariffs, and when there is reciprocation, the same thing happens all around the globe. And so for your firms engaged in international trade, their total revenues go down. Well, total revenues determine the demand for the factors of production. And the factors of production are natural resources, labor, capital. And they cut the demand for these factors of production. And so as the supply curve is shifting inward, these events occur fairly rapidly. Prices go up, quantity demanded goes down, total revenues go down, and the demand for the factors of production goes down. But in terms of the way in which we capture this in the economic data, the process is probably going to be slower than what's actually happening in the real world. Makes it very difficult to sort through. Now, if you go back and look at the period from the 1920s to the start of World War II, there are a lot of important generalizations that we can use. Um, the major economies of the world, the major European economies, were considerably weakened by World War One. This was particularly true for England and France and Germany, of course, because the war had been centered there. And so when World War One started, the major European countries went off the gold standard. They had to. And so the issue was trying to return to the gold standard. And the French were to do so. They did this in 1925. And they did something that was very beneficial to them, but hurtful to the rest of the world. They set the new value of the French franc considerably below where it had been. In other words, they massively devalued the French franc. Now, the British and anyone that was interested in the matter realized that this was going to benefit France at everyone else's expense. But they let France do it. After all, France had been mutilated by the French warfare and the casualties and the damage. And so France started running a trade surplus. And France at that time was a major producer of agricultural goods and industrial goods, which meant that they were then able to steal output from the rest of the world. It's basically the same effect as a tariff. And so as the repercussion of the French devaluation in 1925 took effect, it eventually led to other devaluations. In the late 20s, the Dutch East Indies, which is now Indonesia, devalued. And then Australia devalued. And then there were multiple devaluations in Latin America. The British returned to the gold standard, and in a move that was quite harmful to them, they returned at the pre-war level of the pound, which meant the British pound was overvalued. And so there were all kinds of stresses in the United Kingdom. And so the United States, as a result of the actions that were occurring around the world, we were beginning to run large trade deficits. And we retaliated by something called the Smoot-Hawley tariff in 1930. We didn't go off the gold standard, or we didn't devalue in terms of gold, but we took another action that falls under the category of beggar thy neighbor. Well, it really doesn't matter whether you devalue or whether you raise tariffs or impose capital controls. They're all going to interfere with the flow of international goods and capital, which are the reciprocal of each other. And so after we did this, the Smoot-Hawley tariff, there were another whole round of currency devaluations. And in 1931, the British devalued. And then we eventually retaliated again in 1933. And I don't remember the exact number of devaluations against gold that occurred, but from the French devaluation to our devaluation in 1933, I think it was approximately 30. In other words, one retaliatory action then beget more, and the whole process reduced demand, and it was rather deflationary, not inflationary. We don't want to go down that road.
Okay, that's really interesting, Dr. Hunt, because I feel like oftentimes people point to tariffs being inflationary, but what I'm hearing from you is that they have like these more recessionary effects, as you point out. Those are going to be the ones that will dominate.
They will. Monetary policy comes to play and has an important role. And we showed a chart in our letter that of the trend adjusted real M2 which we have going back to the founding of the first year of the Fed's operation in 1914. And we like to use a 4-year moving average because that's the general lead time between the deceleration in detrended M2 and the start of a recession. And if you look at that chart or if you do that calculation yourself, what you'll see is that we now have the ninth instance since 1914 where real detrended growth over the last 4 years is negative. And the second instance was really the 1920s and 1930s. And so the mistake that the Federal Reserve made then, and for which they were greatly excoriated by Milton Friedman and also Ben Bernanke, was that they didn't reverse the decline in money supply. And then that exacerbated this downward spiral. And right now, on a real detrended basis, over the last 4 years, M2 is declining again. I might point out, before we leave the subject, that all of this buying in advance of the tariffs, not only did it lift imports and inventories and possibly hiring and consumer spending and a whole host of other things temporarily, it also had some impact on the balance sheet of the commercial banks, the deposit creators.
Interesting.
Because people, to finance the buying of imports, have to go to the banks for loans, and this increases loans and deposits. And I think that one of the part of the smoke here is that there was the tariffs impacted the bank balance sheet and money supply, but that will reverse out. And what we're going to find is that this little blip that we've seen in M2, which really hasn't changed very much, the 4-year average, will reverse. And so I think that monetary policy is too restrictive, and that it will not be possible to bring forth a recovery in economic activity in 2026 unless the Fed reverses. And so one of the kind of problems for all of us is that all this smoke and the concern temporarily over inflation puts the Federal Reserve on hold, and because they use this ruse of data dependency, which I think is a flawed concept, because the data is often subject to revisions, all kinds of one-off distortions. The GDP numbers have been revised downward last year. And the payroll numbers, which you had a bigger reaction to today, it's literally one of the worst series for revisions. Been a consistent overshoot between the payroll jobs and the quarterly census of employment and wages. And yet we react to it every month as if it's meaningful. We really don't know that. And one of the things that I know is a small technical matter, but the birth death model, which picks up the small firms, actually added in about 10,000 more jobs this April than it did a year ago, even though this April had the benefit of Easter, which may have been worth a 30 or 40,000 miss. I mean, these kinds of distortions occur all the time. Some of them are very technical, but the whole process of relying on this data is not a good approach. But that's where the Fed is centered, and so it delays them taking a bigger picture and understanding that they have to look and try to evaluate the economy on its fundamentals rather than relying on so-called data dependency.
Monetary Metals offers you the ability to grow your wealth outside the banking system and gain greater control over your finances through gold. Increase your precious metal ounces every single month. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities to earn 4% on gold, paid in gold in their marketplace. And the interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. Well, Dr. Hunt, speaking of the restrictive monetary policy, one of the data points that you've educated me on and this audience on, that's one of these really important factors to look into, is other deposit liabilities. Maybe for folks who might be a bit new, could you explain that and the importance of that? And it's been decelerating and it's been negative. And that's also a bit of a warning sign as well.
Yes. We're only able to take you back to 1963. Other deposit liabilities would be M2, excluding currency and the money market mutual funds. And the reason I exclude currency is the currency is a medium of exchange. There's no question about that. So it is money, but its influence is diminishing, and it's going to continue to diminish. And I don't want that secular influence in a variable that I'm trying to use to calibrate cyclical movements. So I at this stage of the game, eliminate the currency. And then the money market mutual funds, I don't include. I follow Friedman in this, the Nobel laureate. The money market mutual funds cannot create deposits. For them to buy a commercial paper or a treasury bill or some other short-term instrument, they have to go out and bid for the deposits. And so the deposits come from the existing pool. They may speed up the rate at which deposits turn over, but they cannot create deposits. So I prefer to look at other deposit liabilities. And so when the real detrended 4-year growth rate is at zero, the monetary policy is neither too hot nor too cold. Currently, it's quite negative. I might also share with you here that the lead time between the peak and detrended 4-year real ODL and the start of a recession is more than 3 years. And if you exclude the 2001 recession, which probably wouldn't have been a recession without 9/11, it's 40 months, which is close to the 4 years. And so the monetary restraint that the Fed put into the system is still there, and that's one of the elements that is very hidden. It takes time to work its way through. And so monetary policy is too restrictive. Either using M2 for the longer time period, going back to 1914, or using ODL for the more recent time period since 1963.
So you have to look at the world the way it is. But it does make me wonder, Dr. Hunt, if we could put that lens on, what should the Fed be doing? We have the meeting next week, the FOMC next week. What should they be doing?
I think that they should ease. I don't think they should postpone the system. And I say that because we're getting a current significant downshift in federal spending. Taxes will be cut next year. Well, they won't be cut that much. It's mainly going to be making permanent the 2017 so they don't go back up, and maybe tax cuts for tips and a few other items. But there is not going to be a massive tax cut. And moreover, I think it is very unwise to assume that this tax bill will have a quickly beneficial impact. If you go back and look at the Reagan tax cuts in 1981, they were slow to work, and in fact, they were so slow working that the economy was in bad shape when we had the congressional elections in 1982, and the Republicans were suffered very heavy losses in the congressional elections of 82. But this time, I think the tax cuts will work, or the tax changes will work more slowly, because in 1981, gross government debt was 30% of GDP or thereabout, and it's now 124%. It's
Oh,
not the same deal.
mm-hmm. Yeah, I was going to ask you, like, why is it that they would be less potent? But that's a good point. The government debt, it's a lot bigger portion of the GDP.
So we're in an interregnum. So we know fiscal policy is coming down. We have the economically depressive effects of the tariffs. We know from prior historical experience, as well as the theoretical model, the microeconomic model, which I explained to you. Yes, prices go up, but quantity demanded and total revenue goes down. I mean, they're not separate acts. Mm-hmm. And so I think the Federal Reserve needs to take the longer term view. But because they are data dependent, and the inflation rate, while it's coming down, is still above their target, and so they're going to be on hold at a time when they shouldn't be on hold. But that's what they're doing, and I think that the dual mandate of the Federal Reserve has served them very poorly. There should only be one mandate, and that's the inflation rate, and the inflation rate over time, not month to month or quarter to quarter or even year to year. You have to look at it from a long-term perspective. I think the Federal Reserve is misfocused.
Why do you think that is, Dr. Hunt?
Well, let me just tell you this. Why we're in this predicament and their thought process, I cannot share with you, but I can tell you this. One of the key things that they think in that monetary policy works is through something called forward guidance. And my view is that the forward guidance has resulted in a shift of investable funds from the real economy to the financial economy. By focusing on, and they've given too much weight to the stock market, equity markets, and so whenever the equity markets begin to waffle, they come in and support it, and they've created this impression that financial investments in equities are a higher returning, more liquid, and safer assets than investment in plant and equipment. And so it has caused a reallocation from the hard assets that raise the standard of living into financial assets, which serves us very poorly. And if you look at what the debt's been a factor here, debt's been going up, which is adversarial to growth through diminishing returns. Forward guidance has encouraged investment in financial rather than real assets. And between the two, in the last 20 years, our real per capita growth rate has dropped to 1.2% from 2.3. It's a 40% decline. Part of the blame is fiscal policy, but the Federal Reserve has contributed to this negative impact. And there's no question in my mind. And yet they go ahead talking about all of these short-run movements and relying on data series that are revised and are very little of value in the long run. And that's the policy outcome that we get. But I'm afraid monetary policy is very misplaced. in terms of the way it's conducting itself.
It's a good point that you make too about the reallocation from the hard assets to the financial assets, which has served us poorly, as you point out. Does that
May I
also?
just say something here?
Yes, absolutely.
I'd like to say that this evidence is generated from my research, but um, the Nobel laureate Michael Spence, working with Kevin Warsh, former member of the board, outstanding economist in his own right, did a great deal of work on the impact of quantitative easing and forward guidance. And their scientific research shows that Federal Reserve policy has shifted resources from the real economy to the financial economy, which undermines economic growth. I'm really just parroting their outstanding research.
Oh, I appreciate that. Does that, Dr. Hunt, does this also relate to, I want to bring up a concept that we discussed last time, the negative net national savings. Does it tie into that at all? Or is that totally separate?
The well, it part no the the out of net national saving, you can allocate it to either real or you can allocate it to financial. And so but the net national saving pool is coming down, mainly because we've tended to live beyond our means. The bulk of our consumers are spending far more than they are really capable. Um, the bottom 50% of our economy basically have no saving. They need all of their resources in order to properly meet the essential needs of the household. And one of the reasons is that for this situation, which has become, as the real per capita growth rate, the standard of living growth has come down, the bulk of the burden is falling on our modest and moderate income households. It's not falling on the top. And so what we have to do is we have to reorient, policy needs to be reoriented so that our younger households, those in the middle range, close to the middle range, can have the aspiration of a rising standard of living, and they don't have that now. And that's really one of the major changes. And unfortunately, because the standard of living growth has been decelerating, our birth rate is dropping precipitously. And I think that one of the reasons for that is that these young households have come to the conclusion that it's too difficult to have children, too financially expensive to have children. And moreover, these households are not sure of their own financial future. And so they're having fewer children, they're delaying them, and the delay in many instances interferes with their ability to have children if and when they decide to do so. And so the birth rate in 2023 and 2024, the two lowest years on record. 24 was a smidge above 23, but that's really immaterial. The 2 years are horrific, all-time lows. And the great French philosopher Auguste Comte. Did you ever take a course in philosophy?
I did. I took a course called Why Be Moral for my freshman year, but I know what quote is coming, so I'm waiting for it.
I don't think you would have learned Comte. He was a great thinker, late 1700s, early 1800s, and he gave us the famous phrase, "Demographics is destiny."
Yes. Okay, so speaking of demographics or destiny, then let's explore this. Okay, all right, so we're kind of in this precarious situation. If you just look at our debt situation here in the U.S. and maybe more of just the broader situation, the fiscal picture, and then the demographics bit, if you're not seeing or people delaying forming these households, they're not making these purchases like buying a new home or a car, having children, and then if you delay it and the birth rate is low, I wonder there are probably generational consequences because if it's a smaller generation too, they're going to also inherit a lot of these problems, I imagine, too. Is that part of that, the demographics thing? It sounds like you could
Yes,
get yourself in a
and
really long-term
I think
problem.
that that is a reason why we're going to need to have immigration, but the immigration must be legal immigration, um, and we need to acquire those that Milton Friedman looked at. The Nobel laureate looked at immigration very extensively, and he said that whenever folks immigrate to the United States for economic opportunity, it works well for everybody. The problem is when there a lot of the immigration is coming here for us to support. Now, the illegal immigration, some of those folks did go to work, but a very high percentage were relying on public funds. Some of them were employed, some of them employed and took public assistance, but it's not like in the old days. And moreover, the United States is no longer a wealthy country. And unfortunately, with the illegal immigration came some other problems because there was a criminal element and flow of drugs and sex trafficking and a whole host of other things occurred. And so the surge in illegal immigration over the last several years probably added a considerable amount to the GDP growth rate because the folks came in, some got jobs, but a lot required assistance. Most of the assistance ultimately came from the federal government. Some came from state and local organizations, but the federal funding flowed through to a lot of what we call NGOs, non-governmental organizations. And so the illegal immigration did boost employment, but it boosted employment of those that got work, but it may have boosted employment even more for those that were providing assistance to the massive surge in folks coming in illegally across the southern border. And so we need immigration, but we also need it on the terms in which it benefits the American economy. It has to be for economic opportunity, not for public assistance and not for illegal activity.
So, Dr. Hunt, based on these five different factors, the tariffs, monetary policy, fiscal policy, the debt overhang, and demographics, is it fair to say we're headed toward recession? I would
I
love to
feel that
hear.
we are, yes.
Okay. Do you have sort of a perspective on what that might look like if it's like a short,
No,
sharp one or
I
long
just
and
feel
drawn out?
I feel that the economy is facing a long, difficult slog, um, and I think that the tax changes will not work quickly nor effectively in the current environment.
Mhm.
And another problem here too is that too much of the focus is on the short run. Very little of the focus is on the long run. And you know, we've had some pretty great economists that have looked at over indebtedness. You can go back to David Hume, one of the greatest minds of man, Adam Smith in the 18th century, David Ricardo in the early 1800s. And then later on, you get Nikolai Kondratiev. And then in the 20th century, you get Irving Fisher, and you get Hyman Minsky, Charles Kindleberger. And now in the last 25 years, you have research from really outstanding scholars using econometrics and other scientific measuring effects, such as the great Swedish economists Hendrickson and Berg, and then extensive work of the Reinhardts and Rogoff and a whole host of others. And what they show is that over-indebtedness depresses economic growth. And part of this is that if you overuse a factor of production, you trigger diminishing returns. Another element is that the interest expense builds up. And one of the things that's happening to us now is that the interest expense is on the path to move above what we're spending for defense. And the great economic historian Neil Ferguson, author of The Ascent of Money, formerly at Harvard, now at the Hoover Institute at Stanford University, has shown that great economic powers begin to crumble internally when interest expense exceeds military. If you read Ferguson's paper, Empires on the Verge of Chaos, he looked at 4 specific great empires: Mesopotamia, Rome, the Bourbons of France, and the British Empire at the end of World War II. And in each of those cases, the debt undermined the viability and sustainability of the economy. The interest expense became too great. It's a deadweight loss. Doesn't pay salaries, doesn't pay soldiers, doesn't build bridges. Mm-hmm. And that's where we're headed. And in our particular case, 30% of the interest is being paid to service our debt, treasury debt held by foreigners. And so the debt has to be dealt with. And as far as I'm concerned, if we get a tax package and spending package next year, and we don't alter the deficit curve, then the debt today is almost 125% of GDP.
Wow. Yeah,
the high watermark of World War II, when we had 30 million folks in the armed services, was under 120%.
Wow.
The Reinhardt and Rogoff deleterious impact point is at 90%. We're all above these levels. And one of the things which I think will work against us for a long time is the debt surged during the pandemic, but then when the economy recovered, there was no meaningful reduction. Mm. In the past, we were at least able to cyclically get some significant reduction in the deficits and the debt. And there's really nowhere you can go in the federal budget to alter the trajectory that well. And so our ability to control the debt buildup and prevent it from going to 150% in 25 years or 30 years is diminishing. And that's where the OMB and the CBO are suggesting that we're going to go in 2 decades, more or less. So we've got a very serious problem here, and it's not going to go away.
Yeah, I'm looking at the debt clock right now, Dr. Hunt, 36.79 trillion and ticking higher. And I mean, it's a bleak picture when you think about it, and we have a serious situation. But it is. Doesn't seem like there are many options.
One thing that people need to do is they need to focus on gross debt, not net. It is true that there's a little bit of debt held by the trust funds and so forth. The problem is that the liabilities of the trust funds, Social Security and Medicare, are far greater than the Treasury securities that they hold. Mm-hmm. And as bad as our situation is, the condition in Europe is far worse because the unfunded liabilities in their social service programs are far greater than ours. And so it's not like this is just a U.S. problem. It's a global problem as well. And the debt overhang is one of the reasons why not only the U.S. economy is underperforming, but the rest of the world is underperforming.
Dr. Hunt, I have a few viewer questions. Do you mind if I ask those?
Yes.
All right.
Go ahead here.
All right. We have a viewer named Stuart, and he would like to know, Dr. Hunt is of the view that the yield on long duration treasuries will decline in the future. Given the budget deficit and the ever increasing treasury bond issuance, won't the yield on the long duration treasuries have to rise for the market to clear?
Well, the key factor here, there are two key factors that determine the bond yield. The first is the Fisher equation, which says that the risk-free long rate is equal to the real rate plus the expected inflation. Um, right now, if you look at the year-over-year increase in the consumer price index, it's up about 2.4%. Historically, excluding a few extreme situations that don't apply in a normal cyclical sense, the spread is about 150 basis points. So that would put you at 3.9. We're around 4.75 to 4.80. Another way that you could look at it is the CPI has problems in computing the shelter expense, which is 36%. It appears to be very flawed. We now have, really well-honed estimates of what's actually happening to shelter as a result of the advancement of computers and surveying and so forth. And there's a major inconsistency between what those surveys are saying and what the Bureau of Labor Statistics is computing. So if you exclude the shelter component, we're running about 1.4. And historically, the bond yield would be about 200 basis points above that, which would be 3.5. So if I'm right that the inflation rate is going to hold at this level or go down, eventually the bond yield will move into alignment with where the inflation rate is. Right now, the process of adjustment is always slow. The other element that matters quite a bit over the short term is the direction of the federal funds rate. And the federal funds rate is going to need to decline cyclically, in my opinion, in order for the economy to recover next year. And so I think those two forces together will be enough to pull the bond yield downward.
And that's for the 30-year?
Yes, and the 10-year as well. Yeah.
Okay. Somebody asked, another person named Jerry asked, please ask him how far the 30-year U.S. Treasury yield drops in 2025, 2026. Do you have a timeline for the 3.5 handle on the 30-year?
All I can do is point you in the right direction.
Okay,
hopefully.
got it. But just the forces. Okay. Let me see. I have, another viewer question here. I think you kind of covered this, but I'll just ask it anyway. But they said, Dr. Hunt is fantastic. I'm looking forward to the interview. He called for disinflation a year ago, and so far that appears to be happening. However, tariffs are a curveball. I would love to hear his views about what happens in the next 12 to 24 months and how the Fed will respond.
Tariffs are ultimately deflationary. And that is also quite true when you have a real when the money supply in real terms declines. And I think we're going to very shortly see that the money supply was just one of a broad group of economic variables that were impacted by the tariffs. Tariffs affected imports, they affected inventories, they affected vehicle sales, buying of cell phones, a lot of different types of raw materials and so forth. But it also had an impact on bank loans and bank deposits. Deposits are money supply. And so the little blip that we saw here that was related to advance buying ahead of the tariffs has, I think, given a false indication of where the money supply currently is.
Got it. I don't think you can answer this one, but this person would like to know, while he doesn't specify investments that might do well, it would be great if you could get him to confirm or deny gold stock trajectory, also his views on the Fed's next response to tariffs and economic conditions. I don't know what you can say about markets, but if you have a point of view, we'd welcome it.
I can't go there because we're registered with
Totally fair, Dr.
SEC, and
Hunt. Yeah.
our code of ethics doesn't permit it. It implies that I'm making some sort of guarantee or that I'm advertising or so forth and so on. I just am not in a position to go there.
Hmm.
And really, I don't I don't have any capabilities beyond possibly suggesting broad trends.
Hmm. Well, I
That's
totally respect that. No, there's absolutely no need to answer it, Dr. Hunt. We just love listening to you and learning from you. I feel like we all get a deep dive in economics every time you come on, so it's always a treat. Let me ask you this though, because as we were talking about the five forces at play and this kind of decelerating, slowing economy, recession on the horizon, is there anything that you're seeing out there that could potentially be like a growth engine? Is there a panacea that exists? Maybe more of a hopeful outlook at all, if there
well, we,
is
we
one?
do have some growth engines that were working. For example, in the first quarter, um, the high tech category that would pick up the AI and data centers and so forth grew at a 69% annual rate. Uh, that was a big factor. Um, uh, as a matter of fact, if you exclude inventories and exports from the GDP in the first quarter, we actually had a positive growth of 2.4 versus the GDP decline of 0.3. Um, of that, more than 50% of the 2.4 was in the high tech sector. That one narrow component of the high tech sector. Um, I'm pretty sure we're not going to have a 69% rate of increase again. It can be fast, but there's going to be a decelerating trend. Another category which grew very sharply in the first quarter was aircraft. Um, but here too, that's not going to sustain still. Boeing had been on strike there in late 2024, and in the first quarter they delivered 9 months of planes in late in the first quarter, and that produced a 22% or something growth rate like that. That will be in fact negative. Um, the So the federal sector spending declined um, slightly in the first quarter. I think it will decline more sharply in the second quarter, and even more sharply than that in the third quarter and the fourth quarter. Next year, it's too difficult to say because we have no idea what the main budgetary package will be. It's a very high probability that they will not allow the tax rates to rise, which they would do without this bill. We would revert to the pre-2017 level, and that's not going to happen. Economy could not absorb that. There will be some tax reductions, true reductions. I think there'll be some for they will eliminate the tax on tips and a few other items, but I don't think it will be very extensive because there's no room to achieve a bending of the debt curve and the deficit curve. Um, I don't know what will happen with regard to the top tax rate, but in my opinion, um, it would be good for the country, not only from it, the financial impact is not that great, but I think it would be good for the country if the top tax rates went up. It would contribute to help bending the curve, and I think it would be a sign, a concrete sign that a major emphasis is to try to bring back the modest and moderate income households. And we'll see whether that's done. I don't know whether it will happen, but a lot of things are up in the air. And at this stage of the game, all we can do is speculate.
Yeah. Well, Dr. Hunt, I have to say, it's always a pleasure having you on. I just love, again, I'll say it so many different times, but I love listening to you. I love learning from you. You make economics so enjoyable, and you help all of us learn and get better. And before I let you go, if any parting thoughts for this audience, anything that you would like to leave them to think about? It could be something you want to reinforce from this conversation, or maybe something that we didn't bring up. The floor is all yours.
I think that it's best for the economy at this stage of the game that these tariff disputes be resolved as quickly as possible. I personally feel that it would have been better for the administration, for the whole economy, if the tariff issues would have proceeded one country at a time rather than dealing with the world. I think that was a big order. And I think that is a major source of instability. I said to you earlier that I think for the economy to have recovery in 2026, the Federal Reserve has to adopt a more expansionary monetary policy. But another requirement is that the tariff battle needs to be resolved quickly and move to the back burner and let folks concentrate on the underlying fundamentals.
Dr. Lacy Hunt, Chief Economist at Hoisington Investment Management Company. Thank you so much for being so generous with your time, all of your knowledge, your wisdom. Really appreciate you and looking forward to our next
Thank you.
conversation.
Okay, all the best, Julia.